Hi everybody, welcome to our webinar today with Jennifer Wong, talking about impact investing and effective altruism. My name is Jack Lewis. I'm the Executive Director of One for the World. We are a movement of people giving 1% of our income to the world's most cost-effective charities. And we're going to tell you more about One for the World as the session goes on. Right now, we have a slight technical issue with Jen's sound, so I'm going to unmute her and hope we don't get a huge feedback loop, but we should be able to hear her in a second, so we'll just test that out. Jen, say hi to everybody.
Hey everyone. I think I got it to work, Jack.
Amazing. This sounds good. This sounds excellent. Okay, fantastic. Great. This is the second best scenario after it just working straight away, but it proves how good we are at adapting and overcoming. So just before we get going, a couple of housekeeping items. We are recording today's webinar because we're hoping to use the video and the audio in the future. We have disabled the chat function in order to encourage you to use the Q&A function. So if you look at the bottom of your screen, there is a function called Q&A, which you can use to put questions in for Jen or for me as we go on. And my colleagues, Lauren and Kenan, will be monitoring that feed and feeding questions into us. So please do use that, because we'd much rather ask the questions that you come up with rather than the ones that we've prepared. And finally, we're hoping to wrap up in about 40 minutes time. And about halfway through, I'm going to tell you a little bit more about One for the World and how we'd like you to get involved. So to kick off, I'm going to do Jen's very quick biography. So Jen studied economics at Berkeley and graduated in 2010. She then did an MBA at Wharton, which is where she first came across One for the World. And since graduating from there, she's been working at Glenmede on the impact investing side. She is a portfolio manager and has a role assisting the Director of Private Investments in all aspects of investment selection and portfolio management across fund investments, secondaries, co-investments, and directs. And if that doesn't mean an enormous amount to you, don't worry, because I also don't understand several of the things that I just read. So, Jen, this leads me neatly into my first question. As I often say to you in your role as chair of the board, treat me like an idiot, and please explain to me what impact investing is and what you do.
I feel like there are a lot of very big buzzwords in that background. So in terms of what we do with impact investing, you know, a lot of people know it as like all these different acronyms: socially responsible investing, corporate social responsibility, environmental, social, and governance. So like, you know, you have CSR, SRI, ESG, like all of these acronyms. And usually when we talk about what impact investing is with our clients, tell you to take all of those acronyms and just throw them out the window, because what impact investing at its core is really aligning your values with your investments. And so if you look back in the history of impact investing, like way back into like the 1500s or so, the Quakers were probably the first impact investors, because, you know, the Quakers can't invest into certain things like firearms. And so like there was always this notion of aligning those values with your investments. And that notion of like being able to segment out, say, like guns, tobacco, alcohol, etc., is something that is called negative screening, which is where you screen out entire industries. What's interesting and why the rise of impact investing has really happened over the last, say, like decade or two, is because we've kind of shifted from negative screening to positive screening. Positive screening means you take into account all of the data and all of these different metrics that we're able to now capture for companies, and reward the companies that are really doing well by those metrics, while not investing into the companies that are scoring really poorly on those metrics. And so that notion of positive screening, so still keeping investments into, say, oil and gas, but investing into the best oil and gas companies that are showing demonstrable strides in making a better environmental atmosphere for us all to live in, is something that we do in positive screening. And so because we're able to still diversify across sectors, I think impact investing has taken off a lot more with mainstream investors because of this. But happy to dive into details whichever way you want. I think it's impact investing is different across different asset classes in what you're able to do. In my world, it tends to be private equity, which means you hold onto companies and you hold them for 5 to 10 years at a time. You work with them on growing, and so you're able to have much more tangible, high impact things than if you were a very passive investor that was just buying shares of stock for, say, like a Google or an Amazon.
And so you were talking about positive screening there. Can you give us some examples of the sorts of things that you will score companies on when you're positively screening them?
Yeah, so there are two main buckets, I think, in public investments right now, or the public stock markets, where people are kind of, using these metrics. The first is ESG data. So environmental, social, and governance issues. There are a number of different data providers out there, MSCI being the largest one, that will track all the public companies on how they are doing versus certain environmental scores, certain social scores, certain government scores. And then they'll release all that data. People like my firm are then able to take that data and build investment strategies around it. Another kind of like bucket of data that I think is gaining a lot of traction is diversity data. And so of note, I think what has been on the rise is something called gender lens investing. So the way that you would score companies on kind of gender data is looking at whether or not they have a female CEO or chair, looking at the percentage of women on the senior executive board, or looking at the percentage of women as board members, and then kind of layering in that filter at the very top. And then the companies that drop past that filter, you're able to run the same sort of financial analysis on and to determine which ones would be recommended to invest into.
So do most impact investing companies publicly state which of these things are important to them when they're scoring? Because obviously a company that's looking for a high proportion of leaders being female could end up with some very different companies to a fund that's trying to invest in companies that have the highest environmental score. So is it typical for impact investors to say what their priorities are?
Yes. So I think for the most part, there are a number of people that, well, I guess yes and no. It really depends, right? So if you're a foundation where you have your mission that's already set in stone, I think that obviously is a way of doing values-based investing that is very clear cut, because to set up the foundation, you kind of have to put that into your mission statement. And then I think when you get into kind of families, which we work a lot with, it really depends on whether or not that family is what I would call impact purists, where they have a set defined impact that they want to have with their capital. And so they try their best to align to that. Anything else they'd like to be educated on, and they'll work with their investment advisor on. And then you also have a set of investors where they say, we just want to be more responsible in our investing. Please tell us how. And then we kind of walk them through the different options that they can have an impact with their dollars, and go from there.
And so just picking up on this theme of there being sort of different definitions of what impactful might mean in different places, and even within a company, because you may be scoring on different metrics, how do you typically measure impact when you're looking to invest? Yeah,
so that depends. I feel like I'm going to answer all of these questions with it depends. But first, I think what I want to caveat all of this with is that impact measurement is probably the last big challenge to scaling impact investing, because to your point, there's a lot of inherent challenges in how you conform to how you measure impact. You all at One for the World probably see that in how you're able to compare, say, like, one of your portfolio charities to another one. Like, who's to say one impact is better than the other? So it's obviously very difficult. In my world, it tends to be difficult in terms of comparing companies across different sectors. So like, how am I supposed to say that, a healthcare company that is decreasing the cost of healthcare, expanding access to healthcare, can be measured the same way that, an energy company that, building renewable energy plants and decreasing carbon emissions, who's to say who's better? So I think, one, it's a very challenging environment to kind of measure all of this impact, but I would then also try to say that we should probably go back to how you invest first, right? So if you think about the different asset classes that you can invest in the public markets, so investing into public stocks and bonds that are traded on any of the large stock exchanges, I would say that impact investing is driven more by process, driven by how fund managers are able to articulate how they are doing or achieving impact. So for instance, that gender lens example that I gave you is what a lot of public markets gender lens equities investors do. They will say, here is the basket of large cap stocks out there. We're going to take that entire universe. We're going to run it through this filter. Whatever comes down to the bottom, we will then, follow our same tilt for, et cetera, and run through our same strategies to end up with the core set that we're going to hold. That's different than what you get in the private markets, which is what I focus on, where anything that isn't publicly traded on a stock exchange falls into the world of private investments, right? In private markets, I think when you talk about impact, is driven a little less by process and a lot more by the outcome, right? So when you say, I want to channel money to, decreasing carbon emissions, in the public markets, what you can do is channel money to, say, thematic bonds that, are going out and backing, say, like people that have built solar companies in the past or solar farms in the past, right? Giving them capital so that they can continue financing operations, et cetera. In the private markets, it tends to be a little different. You can actually go out and say, I think that the energy dynamic or the energy landscape in the country of Egypt is extremely attractive. I think there's a growing middle class that is going to want access to energy. They are willing to pay for energy. Right now, there aren't a lot of power plants in Egypt. And we think because of how much sun they get, solar is very attractive there. And so you're able to kind of pinpoint targeted investments that you want to do. And you're also able to then tie it to exact outcomes that you would have. Whereas it gets a little more tricky to do because it's a little more murky in the public markets, your specific impact as a much more passive investor.
This is a really interesting idea for me, and I think it's quite exciting with impact investing. So is it possible, and maybe this already exists, I don't know, but to have a fund which is really aiming for maximum impact and a sort of minimum financial return? I sometimes feel like in some impact investing firms, it's the other way around. We're going to have a kind of minimum baseline level of impact, and then within that, we're looking for the highest possible financial return. But could it, in theory, happen the other way around?
You do see this. There's a large number of providers out there in what is called the concessionary bucket. So high impact concessionary vehicles. There's a couple fund managers that we work with that do that on more localized levels. So they're able to say, Jack, you have $10,000 extra that you want to invest, and you're willing to invest it into a low interest rate bond, right? I'm more than happy to take my $10,000, and I really care about expanding access to good food to low income communities, right? You would then go to this fund manager and you would say I'm happy taking 2 to 3% off of this loan that I'm going to give away, if that means that this loan is going to help build grocery stores in these low income areas and neighborhoods. Can you do that for me? And so they'll have a number of different projects that they've already vetted and worked out. That is one example that you could do it with. But yes, there are people that are building kind of high impact concessionary vehicles. I think the challenge is the $10,000 is probably a little too low, but I think it all depends on how much money you have.
Well, this is my ambition for your career, is for you and Nadav, who's also on our board, to set up the most impactful impact investing fund globally. So I don't know if Nadav's dialed in, but this is my vision for both of you within the next 10 years, if you could prepare for that. We've got our first questions coming in through the Q&A, and the first one's what I'm interested in as well. Very good question from Rory. To what extent are the screening criteria that you use always quantitative, and to what extent do you use any qualitative assessments of your investments?
Yeah, I think that's an interesting question, right? I think within finance, we are people that are very conditioned to having qualitative assessments done, and so numbers resonate very well with us. I think in the public markets, it's likely hard to do qualitative assessments and be able to do that at scale, and for you to do it repeatedly over and over again when you're vetting thousands of companies. I think when you look at the private markets and your portfolio may only be made of, say, a fund would have maybe anywhere from 10 to 30 companies, it's much easier for you to then be able to take that qualitative one. Sorry, I think I just messed those two up. Quantitative would be hard in the public markets. Or not quantitative would be hard in the public markets, but you would be able to take a more qualitative ones in the private markets and still be somewhat okay. But I think there is a bias towards having much more quantitative measures to measure things by.
Great. I did follow that, irrespective of your use of qualitative and quantitative. There is another really good question here that I'm interested in hearing the answer to. So in the current circumstances, and I know that it's early doors with the economic impact of COVID, how is Glenmede leaning into investments during the crisis? Are you focused on existing investments or looking for new opportunities? And that was from Juan.
We are doing a bit of both. I can't say much for the public side of the house, but on the private side of the house, depending on which vehicle we are investing out of, there are some that do direct into private equity that, because of what has happened with their public markets and portfolio, they're holding the line a little bit. And so they probably won't be making new investments in the short term. I think, but there are also vehicles that we manage on behalf of our clients where there is kind of dry powder just sitting there that we are actively still looking for new investments.
And I mean, this is probably like asking you to just gaze into your crystal ball, but what do you think the overall impact on your sector is likely to be over the next sort of 12 to 18 months?
Hard to say. Again, I think that's something that's probably more applicable for public markets to be able to say. Private markets don't get mark to market all that often, maybe on a quarterly basis. I think what you will see is probably a little less capital being called and drawn down for investments and a little less capital being distributed right now. I think what a lot of people have done and what we've also done is kind of mapped out what happened to private equity as an industry, private equity and venture as an industry in the last great financial crisis versus now, to try and help us understand what might happen. And what you found back then is a little counterintuitive. The best vintage years to invest into private equity is actually right now. In times of distress, when valuations that were a lot more inflated come back down to earth and become a lot more realistic again, it's a great time for investors, especially private investors that are working and partnering with entrepreneurs to grow their businesses, to really come in, buy at attractive prices, help them professionalize their businesses, scale it, and then be able to get a financial return. In the last recession, I think what you found was that the vintage years leading up to it, so the recession hit in 08, 09, 2006, 2007, where you bought into companies at kind of the height and you were trying to help them weather the storm through the recession, those vintage years tended to hurt a lot more versus, but it's a little counterintuitive because most people are thinking, shoot, I just lost 30% of my stock portfolio. I should probably stop investing right now because what if it keeps going down? And in reality, I can only tell you what happened last time. But in reality, if you had continued investing through it, you probably would have made out for the better.
That's super interesting. So if any of you out there have the ability to invest, I highly recommend contacting Jen and seeing what she can do for you professionally. Now, pivoting slightly to your role at One for the World, you are now the chair of One for the World's trustee board. So the trustee board, for people who don't know, is the group of legal and financial guardians of the charity. So they are key to making sure that we are legally compliant, that we're spending money in a responsible way, sticking to our mission as a non-profit, and also helping us with strategy. You're quite young to be the chair of a national non-profit. So what have you done to prepare for that role, either since assuming it or across your career, and what excited you about taking it?
I know it's kind of terrifying that I was asked to take on this role, but I was very flattered and very excited by it because I think I first got involved with One for the World when I was at Wharton getting my MBA. And what drew me to the organization was this notion of being able to maximize the impact that you're having through your donation dollars, right? Prior to me going to business school, I spent a couple years living in sub-Saharan Africa working in public health, right? Where I was advising governments on how to maximize the amount of impact that they were having with their limited budgets. And so I worked for the Clinton Health Access Initiative, focused on HIV in Malawi and on Ebola response in Liberia. And in both instances, it was working hand in hand with the government in modeling out their budgets and what interventions they wanted to fund against epidemiological data, right? So that we could arrive at, say, this magic scenario by which you were using the least amount of money to do the most amount of good, right? And good, back in those times, was making sure that people were living longer, but that they were also having a much better quality of life. I think I was trying to find ways to do that both professionally back in the for-profit sector, and what drew me to One for the World was this notion that, like, we spend all of this time, we spend all of this energy in making sure that, if I want to buy a TV, I would go out and look up all these other TVs to make sure that I got the best TV for the lowest amount of money. And people don't think about that from a donation perspective enough. And so it was exciting for me to get more involved with the organization when I first did. It was exciting when I got to, sit on the national advisory board and work across different schools as well. So working with undergraduate students and hearing their concerns, working with law school students and hearing their concerns, and then working with business school students. And then I guess what has been exciting so far, since, now that One for the World is filing for its own 501c3 and we've got such lovely full-time employees to run the ship, it's been exciting to see the traction that we're getting across the board, because I do think that, our generation is predisposed to things that are super convenient and predisposed to consuming large swaths of data at any given time. And so kind of making a data-driven way of giving money and maximizing impact a much more convenient way of doing things, I think resonates very well. The way that I was able to try to prepare myself, I took it upon myself to interview as many people as possible that were chairs of boards just across the world. And so I spoke to people that chaired nonprofit boards, all the way to people that chaired our own for-profit board at Glenmede, and then other chairs of boards for large health systems and stuff like that, which was just really exciting because it was very interesting people. And I just asked if I could talk to them because I was I have no idea what I'm going to be doing, but any advice that you have, I would love.
Well, look, you've been doing a great job so far. I'm briefly going to stop the questions because I'd like to explain to everybody what One for the World is. So One for the World is a movement of people who give 1% of their income to the world's most cost-effective charities. And we work with a charity evaluation partner called Giveth. Many of you will be familiar with their work, and we have a webinar with their co-founder and CEO on Wednesday. Giveth are the leading evaluator of charities in the world and put an enormous amount of time, I think they have about 30 full-time staff working on this now, into assessing the most cost-effective and impactful nonprofits in the world. And One for the World is a movement of people who say, once, as Jen was just saying, if you're going to donate, you should donate in the place where your money's going to go the furthest. And so everybody who's a member of One for the World gives a fixed percentage of their income to these charities. So we try to make it as easy as possible to identify which charities you should be giving to. We have a very simple and easy to use online donation platform that lets you set up and distribute a regular donation to a unique combination of these charities according to your preferences. And at the moment, we are recruiting over 1,000 new donors every year. So our main method of outreach is to be on university campuses, where we have volunteers who try to persuade their peers that this pledge is a good thing to do when they graduate. And we have over 30 of those at the moment. We're trying to double that number. So we would love you, if you're at university, to think about setting up a chapter for us. And pretty soon we're going to be rolling out our first corporate chapters as well. And so if you're early in your career at a corporate, or even senior in your career at a corporate, and would like to talk to us about setting up a chapter, please do get in touch. But we're also hoping that people who are dialing into these webinars are going to take the pledge. You know, even in these very difficult times, I think I checked the other day, and the daily global deaths because of coronavirus was at about 2,000 to 2,500 people. That is still substantially less than the deaths caused by extreme poverty every day. There are around 11,000 children under the age of 5 who are dying from preventable poverty-related causes on a daily basis. So we would love to have a conversation with you about becoming a pledger. And that's something that you can do now. The amount that we're asking for is only 1%. It's affordable even in difficult financial times. I'm particularly proud of the fact that we haven't had a single person who's taken the pledge cancel since the start of the pandemic, which I just think is a really heartwarming testament to the commitment people have to this idea. So if you're interested in finding out more about One for the World, if you would like to donate to what we believe are the most effective charities on the planet in an affordable way and have a huge impact on the lives of people who are facing the kind of dangers we're facing at the moment all the time for their whole lives, please do arrange a conversation with us, and you'll be getting an email about how to do that after the webinar. Thanks, pitch over. So swinging back to questions for Jen, a couple of questions on the Q&A I'm really interested in hearing about. Bara has asked, is there an investment bias towards developed countries versus emerging economies in impact investing, in your experience?
Yeah, I think that's a really interesting question because I think across the board as an investor, you tend to be more biased towards instances where you're not taking a lot of currency risk as an investor, just period, right? If I'm a dollar-based investor, I would want to likely put dollars to work because I care about the dollarized return, unless I think that investing overseas would lead to growth outcomes that would outstrip any currency volatility that might underlie my investment dollars. And so I think from an investment perspective, I think there's a bias towards being more domestic. I think when you talk layer on impact, obviously the value of a dollar can go a lot further from an impact angle when you're overseas. And I think One for the World sees it. I think as impact investors, we see it all the time. And so it really depends on what you're trying to look for. The way that we have approached it at Glenmede is the fund that I manage that's more impact oriented in the private markets. We do take a global approach, but we do anticipate that in that fund construction, about half of that fund would be deployed domestically, with about 25% earmarked for emerging markets specifically.
Great. This is slightly chopping and changing now because we're responding to questions in the Q&A, but another one that caught my eye. Have you seen much influence in changing private company behaviors through your fund? And how involved are you and the fund in the top decision-making part of the companies that you invest in?
Yeah, so I'll take a step back really quick. The way that Glenmede invests into private markets broadly is we invest into funds that then invest into companies for the most part. About 2/3 of what we do is investing into these funds, so a more indirect approach, and then the remaining third investing into companies directly themselves. In terms of behaviors, I think it is a little top down, but it's also a little bottoms up just across the board for companies themselves. What you see is that with the rise of impact investing and the rise of responsible investing, people are paying a lot more attention to it. I think the headlines surrounding private equity obviously didn't help anyone in the industry the last couple of years. And so people are cognizant of it. And I think for the most part, excluding kind of the more distressed players and some people at the very large end, what you see is that private equity usually does partner with companies to grow them. And so taking a very short-term approach and measuring whether or not they are responsible, are they like investing into more people and like hiring more people, et cetera, maybe a too nuanced view. Rather, you should kind of take that long-term view and see how they do.
And speaking of the long-term view, what is the type of return that you're usually looking at from your investments?
We don't think that you have to sacrifice returns for impact at the firm. And so we are looking for, in the case of private equity, top quartile private equity fund managers. We're not, we do have a couple concessionary products on the platform, as I was mentioning earlier, but for the most part, we think that any impact manager should be able to stand up to a not self-defined impact manager and still be able to provide the impact outcomes.
Great. I'm conscious that we have quite a few students watching this from our chapters across the US. And so I did want to ask you, if any of them are really interested in a career in impact investing, what would you recommend that they do now in order to make themselves an attractive candidate for a firm like Glenmede?
Yeah, I talk to a lot of students about impact investing, and I always tell them, the best thing you can do as a student is to walk the walk and not just talk the talk, right? Anyone can put together a cover letter and say that, yes, I'm so interested in impact and I'm so interested in investing. But if you actually haven't done anything to demonstrate like a desire to learn and to apply what you're learning in the classroom to practical things, then you're probably not the best candidate because you didn't go that extra mile to try to walk the walk and not just talk it. And so obviously, if you want to get into impact investing, then you have to know impact investing. And so to put a little plug in for One for the World, I think, taking the One for the World pledge and like becoming a part of One for the World makes a lot of sense on the impact side, right? Working specifically on understanding how a charity has impact, how to quantitatively and qualitatively define what impact is for a charity, means that you're miles ahead of your competition in terms of trying to break down any sort of organization in terms of their impact capabilities, whether it's for profit or not for profit. And so I think that is huge. I think on the investing side, obviously the ability to, try and do externships or internships with any sort of organization that would give you that kind of finance background or that investment background would also lead you to like be able to do it. And so if you have the combination of those two things, then you're a much stronger candidate for any impact investing role going forward.
Yeah, that's great advice. I was really hoping that you would say that involvement in One for the World is a good idea for your career, although I do passionately believe that that's the case as well. Two questions left, one of which I'm actually going to answer because it's more pertaining to One for the World than impact investing. So Lynn has asked, how does One for the World differ from Giving What We Can? Some people on the call may be aware of Giving What We Can. It's it's a project run by the Centre for Effective Altruism, asking people to pledge 10% of their income to effective charities. One for the World is slightly different in three ways. First of all, we're only asking for a minimum commitment of 1%, although we encourage you to give more if you can. And the rationale behind that is we do think there are lots of people who are committed and are able to give 10% of their income, but we think that there are a large number of people who are either not able to or not yet at that point in their donation lifetime. And so we're looking to create a much broader funnel of people who are interested in effective giving and making a commitment to give. The second crucial difference between us is that we actually process donations for you. So if you want to take the Giving What We Can pledge, which I did and which quite a few of our staff and board have done, you need to set up those donations directly and you need to manage that yourself. What One for the World offers is you can check out in 3-4 clicks and tell us broadly how you'd like your money to be distributed. And we'll then process that for you every month. And there's another advantage of that, which is most people choose our top picks portfolio, which is 5 charities recommended by GiveWell every year as the best place for you to donate. And that's a dynamic portfolio that moves year on year. So unlike with Giving What We Can, where you have to set up a donation and then you are responsible for checking in and seeing if that's still the best place to donate over time, we will do that for you. And then the third big difference is that Giving What We Can say you can donate to any charity that you consider effective. We only support the GiveWell charities. We think it's important to have a statement of what you believe is impactful and then channel donations towards that. And it means that everyone who's donating in our membership can be confident that they're having an extraordinarily high impact with their donations, because we are constantly curating that portfolio for you. So a final question, Jen, for you, the closing one of this webinar. What 3 books or podcasts would you recommend for people who are interested in impact investing, especially during lockdown?
Oh yeah, I heard Ian's answers to this like on the webinar last week, and the How I Built This podcast is one that I've been ripping through as well. And it's fantastic because it basically goes back and highlights all these episodes that they've been doing on NPR about how these people have built these giant corporations and these giant companies. Some of them are very impactful and others are less impactful, obviously, but it's amazing hearing like the stories of how they got through, like what their challenges were, like, you know, what things they had to overcome, etc. So I highly recommend that podcast. Another book that I would recommend that I think doesn't explicitly talk about impact investing, but is the view of, I think, impact and sustainable prosperity that we've taken at the firm, is Clayton Christensen's The Prosperity Paradox. Clayton Christensen is this very renowned HBS professor that is most known for his book called Innovator's Dilemma. And he also did one that was more focused on emerging markets and, like, you know, studying different cases of how companies have succeeded in different environments around the world in building a much more prosperous, like, middle class. And so I think that one's a really interesting one. And then lastly, there's also one that I just really like recommending to people in general, which is called The Red Notice. The Red Notice is about Bill Browder, who was a hedge fund professional turned like investor that focused on Russia during its privatization years. And it is a book that I could not put down. I think I read through it in one night. It was so good. It's a nonfiction that reads like a fiction.
Yeah, I read it last year, actually. Fantastic. That is a really, really good recommendation. Obviously, I'm going to add Tiger King to that list. You know, give yourself a gift during lockdown. It's the best 7 hours you'll spend in almost any part of your life, but especially right now. Jen, thanks so much for joining us. It's been super interesting for me. Maybe you won't have to explain to me what it is that you do again and again now that you've explained it in such detail. If anyone didn't get any questions answered that they'd really like to put to Jen, please do send them in by email and we'll be happy to connect you. And finally, please, please, please do think about getting involved in One for the World. You can make an enormous amount of difference for a tiny amount of money that you won't notice. So we really hope that you will set up a call with us and we'll be sending out instructions for how to do that very shortly. So finally, Jen, thanks very much for joining us.
Yeah, great to be here.